I've been doing this for 45 years. I managed money through Black Monday, through the dot-com collapse, through 2008, through COVID. I've seen panics. I've seen euphoria. I've seen everything in between. And I'm telling you right now, sitting here, what I'm watching in this market is one of those rare moments that I can count on one hand across my entire career. Not a crash, not a crisis, something actually more interesting than that. An opportunity hiding in plain sight while most people are staring at the wrong thing entirely. And the reason I want to talk today is because I'm genuinely concerned, not for the market, for you, for the everyday investor who's reading the headlines, seeing the S&P near all-time highs, feeling pretty good about things and doing absolutely nothing. Because doing nothing right now isn't neutral. It's actually a decision, and it might be the most expensive decision you'll make. Let me tell you what I mean. When I was running the Duquesne Fund, I had one rule that I never broke. Never fall in love with a position. Never. The moment you fall in love with something you own, you stop seeing it clearly. You see what you want to see. You stop seeing what's actually there. And right now, the entire retail investing world is in love with the index, the S&P 500, the idea that you just buy the whole market and everything works out. And look, I understand why it worked for a long time. It worked beautifully. But the world has changed in a way that makes that strategy, in my opinion, genuinely dangerous. And I'm going to show you exactly why. The S&P is sitting around all-time highs, NASDAQ recovering strongly. Everything looks fine on the surface. If you just glanced at the numbers, you'd think we're in great shape. But I've spent my whole life learning that the surface tells you almost nothing. It's what's underneath that tells you everything. And underneath this market right now, there is a war going on, a rotation so violent, so dramatic, that half the index is essentially bleeding out while the other half is flying. Think about that for a second. Same index, same time period. You got stocks up 500% and you've got stocks down 50%, both sitting inside your index fund, both affecting your returns. The index averages them together and tells you you're up 9% and you feel fine. But the reality is you're holding a rocket ship and a sinking ship in the same hand and calling it a portfolio. That's not diversification. That's just owning everything and hoping the winners outweigh the losers. And for a long time, that was enough. I don't think it's enough anymore. Now, before I get into what I'm actually seeing and where I think the real opportunity is, I want to be clear about something. I'm not here to sell you anything. I'm not managing your money. Everything I say is my perspective, my opinion, built from 4.5 decades of watching capital flow around the world. You make your own decisions. You talk to your own advisors. But I will tell you what I see clearly, honestly, the way I'd want someone to talk to me. So let me start with the macro picture, because that's always where I start. Always. You have to understand the environment before you pick a single stock. It's like checking the weather before you decide what to wear. Seems obvious. Most people skip it entirely. Inflation is back. And not in the quiet, sneaky way it was a couple years ago. It's loud now. The official numbers are running close to double the Federal Reserve's target. Energy costs up nearly 20%. Gas prices up close to 30%. You feel it every time you fill up your car, every time you pay your electric bill, every time you go to the grocery store. Real wages, which means what you actually take home after you account for rising prices, are negative right now. So people are technically earning more dollars, but buying less stuff. That's the silent tax that nobody in Washington ever talks about directly, and it has enormous consequences for where money flows. When inflation runs hot like this, certain things win and certain things lose. This isn't a theory. This is history. Hard assets win. Things you can hold, things that are scarce, things that the world physically needs and can't print more of. Paper-based assets, companies that depend on consumer spending, companies that rely on cheap borrowing costs, tend to struggle. And right now, that pattern is playing out almost like a textbook perfectly. But here's something that really caught my attention recently, and frankly, it's something most people never even look at. There's a survey, it's called the NAAIM survey, and it tracks what the professional money managers are actually doing with their clients' money. Not what they're saying publicly, what they're actually doing. And right now, that number is sitting at 97 out of 100. Meaning almost every professional manager is fully invested, 97% allocated. There are almost no buyers left on the sidelines. Now, why does that matter? Because markets go up when new money comes in. Simple as that. More buyers and sellers, prices go up. But if nearly everyone is already in, if there are only three people standing without a chair when the music stops, then the direction of money matters infinitely more than the total amount. And right now, the direction is what's telling the real story. It's not new money coming into the market that's driving things. It's money moving from one place to another, from losers to winners, from the old economy to the new one, from consumer-facing businesses that depend on people spending freely to hard assets and infrastructure that the world simply cannot function without. That's the rotation I'm watching, and it's where the real opportunity is sitting right now. Let me walk you through where I think the money is going. And I'll be specific because I've never believed in being vague when I can be precise. The first place I keep coming back to is gold. Now, I know gold sounds old-fashioned. I know some people hear gold and they think of their grandfather burying coins in the backyard, but let me tell you something. I've had a complicated relationship with gold over my career. I've been wrong about it before. I bought it too early once, got impatient, sold it, and watched it run. Painful lesson. But the setup right now for gold is one of the strongest I've ever seen. And here's why it's different this time. Central banks around the world, China, India, Turkey, Saudi Arabia, they are buying gold at a pace we haven't seen in decades. We're talking somewhere close to 1,000 tons of expected purchases this year. That is extraordinary. These aren't retail investors chasing a trade. These are sovereign governments making a deliberate strategic decision to hold less dollars and more gold. And when the people who are literally creating the inflation, the people printing the money, when they're moving their own reserves into gold, you have to pay attention to that signal. That is one of the loudest signals I've seen in a very long time. Gold is sitting around record highs right now, and I know the instinct is to say it's too late. But here's the thing I've learned about commodity cycles. They go much longer and much further than anyone expects. When a trend has fundamental support behind it, it doesn't stop just because it looks expensive. It stops when the fundamentals change. And right now, I don't see the fundamentals changing. Inflation is persistent. Central banks are buying. Cash is losing value in real terms. Gold doesn't pay a dividend, yes, but it also doesn't lose 60% of its purchasing power over 2 decades the way cash does. And there's something even more interesting than gold itself right now, which is the companies that dig it out of the ground. Historically, when gold miners start outperforming the metal itself, when the stocks of the companies are climbing faster than the price of what they're selling, that usually tells you the market is starting to price in a longer sustained run. It's a signal that smart money isn't just buying a hedge anymore. They're buying growth, they're buying exposure. And we're seeing that signal right now. The second area I want to talk about is one that almost nobody in financial media covers with any seriousness, and that's uranium. I think this is genuinely one of the most misunderstood opportunities in the market right now. Let me explain it simply. The world has a power problem, a massive, urgent, existential power problem. AI data centers are consuming electricity at a rate that nobody fully anticipated even 2 years ago. Every major tech company, Microsoft, Amazon, Google, Meta, they are all building or planning small nuclear reactors because they've done the math. And the math says there is no other way to power what they're building. Solar and wind simply cannot deliver the consistent, reliable, dense energy that a data center needs running 24 hours a day. Nuclear can, and that means uranium, the fuel that runs nuclear reactors, is going from an afterthought to a national security priority almost overnight. The U.S. consumes about 50 million pounds of uranium per year. It produces about 1 million pounds domestically. That is a 98% import dependency on something the government has now classified as a critical national security asset. When a government calls something a national security asset and they're almost entirely dependent on foreign suppliers for it, the policy response is predictable. They will spend aggressively to change that. They will subsidize domestic production. They will sign long-term contracts, and the companies that can supply uranium will be in an extraordinarily strong position for years. The third area is copper, and I want to spend a little time here because I think copper is probably the most underappreciated commodity in the world right now. I've started calling it the new oil in my own thinking, and here's why. Every single major trend that is driving this economy and will drive it for the next 20 years. AI infrastructure, electric vehicles, solar energy, wind power, grid upgrades across the entire developed world. Every single one of them requires enormous amounts of copper. An electric vehicle uses 4 times more copper than a conventional gas car. Every solar panel needs it. Every wind turbine needs it. Every data center needs it. Every power line needs it. And here's the supply side problem that should genuinely keep people up at night. Bloomberg is projecting a deficit of over 1 million metric tons in the copper market, meaning the world will need more copper than it can produce. Major mines in Indonesia and Chile are running into production problems. China is restricting exports of certain copper-related materials. The supply picture is tightening while the demand picture is exploding. I've been around commodity cycles long enough to know what happens when you have explosive demand and constrained supply at the same time. You get prices that go much higher than most people think is possible, and the companies best positioned to capture that upside are the pure play producers with large established operations and real earnings behind them. Now, energy itself, separate from the broader commodity discussion, is also worth watching very carefully. Energy has been the single best performing sector in the US market this year. Not tech, not AI, energy. And it makes complete sense when you think it through. Inflation is largely an energy story. When energy prices run, the companies producing energy print money. Their margins expand, their cash flows surge, and the market rewards that. While everyone was debating whether Nvidia was overvalued, energy quietly became the trade of the year. Let me shift now because I want to talk about something that I think is even more interesting than the commodities themselves, and that is infrastructure. Because when commodities go up, something else always follows, and it's the companies that are physically building the world that those commodities enable. Right now, there's a construction boom happening in America that is almost invisible in the financial media because it's not glamorous. It doesn't have a charismatic founder. It doesn't go viral on social media. But the numbers are staggering. General building contractors in non-residential construction are up over 300% as an industry. Engineering and construction companies up 200%. Water, sewer, and pipeline companies up 200%. Electrical products up significantly. These are real companies with real government contracts, real earnings, real backlogs that will take years to work through. Think about what's actually happening on the ground in America right now. The CHIPS Act is funding semiconductor manufacturing plants. The infrastructure bill is funding roads, bridges, power grids. Every tech giant is building data centers that require enormous amounts of physical construction, electrical infrastructure, cooling systems, mechanical engineering. And there's a broader push to bring manufacturing back to American soil. Semiconductor plants, battery factories, EV production facilities. All of this requires the same things: land, concrete, copper wire, steel, skilled tradespeople, and the engineering companies that manage it all. This is not a one-year story. This is a decade-long construction cycle, and it's just getting started. Now, I want to flip the coin because I'd be doing you a disservice if I only showed you where the money is going and didn't show you where it's leaving. Because remember, this is a rotation. The water moving into one end of the pool has to come from somewhere, and it's coming from a lot of places that are probably in your portfolio right now if you hold a broad index fund. Shoe manufacturing is down significantly as an industry. Some of the biggest names in consumer retail are down 50–60% from their highs, while the index sits near all-time highs. Professional services and consulting firms are getting absolutely crushed. And honestly, I think that's a structural shift, not a cyclical one, because artificial intelligence is doing in seconds what a room full of consultants used to charge millions of dollars to do over months. Those jobs, those billable hours, those business models are not coming back. Some of the largest consulting firms in the world are down 40–50%, and I think there's more downside ahead as this reality becomes more widely understood. Publishing companies, traditional media, advertising businesses, these are all under severe pressure right now. And again, I think a lot of this is structural. The way people consume information has changed permanently. The advertising model that funded these businesses for decades is being disrupted by platforms and algorithms that didn't exist 10 years ago. The largest advertising company in the world has lost 2/3 of its value while the index was going up 2/3. If you held an index fund, you owned that the whole way down. Forest products, certain retail categories, parts of financial services, the list goes on. And here's the thing that's important to understand. These aren't small, obscure companies that you've never heard of. These are household names. They're in the index. They're in your 401k love bits. They're in your retirement account, and they are dragging your returns down every single day while you hold them alongside the winners, averaging down your gains, and you don't even know it's happening because the headline number still says you're up 9%. Now, let me put some real numbers on this because I think percentages can sometimes feel abstract. If you put $10,000 into a broad index fund 2 years ago, you got maybe $13,000 today. That's fine. That's decent. But if you had simply identified the sectors where money was flowing and concentrated there, that same $10,000 could be worth $40,000, $50,000. And if you happen to be concentrated in the losing sectors, that $10,000 might now be worth $4,000 or $5,000. And all three of those people would tell you they own the market. They all hold index funds. The difference in outcome isn't luck. It isn't timing in the traditional sense of trying to predict the future. It's just watching. It's just paying attention to where the money is actually moving and having the discipline to position yourself accordingly and the courage to move away from what isn't working. Now, I to say something about buy and hold because I know it's almost sacred in some investment circles, and I want to be thoughtful about this. The buy and hold strategy was genuinely brilliant for a long time. It was the right advice for most people for most of the past 40 years. The economy was growing steadily, inflation was contained, interest rates fell for decades, which pushed asset prices up broadly. Rising tide lifted all boats, and sitting still was rewarded. I understand why it became conventional wisdom. It worked. But the reason I started in this business, the reason I found success, was because I was always willing to question the conventional wisdom when the facts changed. And the facts have changed. The speed of change in the global economy, driven primarily by technology and AI, has accelerated to a point where the average lifespan of a dominant company has shortened dramatically. The companies your parents bought and held successfully for 20 years, in many cases, simply don't have that kind of runway anymore. Disruption happens faster. Business models get obsolete faster. The winners of today are not guaranteed to be the winners of tomorrow in the way they once were. And what I've observed, what I've watched throughout my career on trading floors and in the biggest institutions in the world, is that the professionals never actually buy and hold everything. They identify where the macro environment has pushing capital. They rotate aggressively into the strongest positions. They cut the losing positions without emotion. And then they tell retail investors to buy the whole market and hold it forever. Because if retail stays still and stays in the index, institutions can trade around them. They collect management fees on your passively held funds. They have stability and predictability in the retail money while their own money moves freely to wherever the returns actually are. I'm not saying that cynically, I'm saying it because it's accurate, and I think you deserve to know how the game is actually played. Now, here's where I want to be honest about the difficulty of what I'm describing, because there's a reason most people don't do this. It's hard, not intellectually hard necessarily. The concepts are complicated. Watching where money flows, identifying strong industries versus weak ones, it's learnable, but it's emotionally hard. Selling something that's down feels like locking in a loss. Buying something that's already up feels like you're late. Concentrating in fewer positions feels like you're taking more risk when actually, in my experience, owning 40 mediocre positions is often far riskier than owning 10 excellent ones. The emotional discipline required to follow money rather than following narratives, to look at where capital is actually going rather than where the story sounds best. That's the skill. That's the thing that separates outcomes over a decade. Not intelligence, not access to secret information, emotional discipline, and a clear framework for reading the market. I want to come back to the big picture one more time before I finish, because I think it's important to put this moment in context. What we are living through right now is a genuine inflection point in the global economy. The commodity supercycle that I believe we've entered, driven by inflation, by the energy transition, by the AI infrastructure build-out, By the reshoring of manufacturing, by the geopolitical shift away from globalization. This is not a one-year trade. This is a multi-year, potentially multi-decade structural shift in where value is created in the economy. And the people who recognize it now, who reposition now, who stop sleepwalking through their portfolios, holding everything the index tells them to hold, those people have an opportunity in front of them that is genuinely rare. I've seen maybe 3 or 4 moments like this in my career. Moments where the macro picture was clear enough, where the rotation was obvious enough, where the gap between what was working and what wasn't was wide enough that the right positioning could change someone's financial life permanently. This feels like one of those moments. The gap between the winning sectors and the losing ones right now is, in my observation, as wide as I've seen it. And it's going to get wider before it gets narrower because the structural forces driving this rotation are still in their early stages. The AI infrastructure build-out is maybe 2 or 3 years into what will likely be a 10 to 15-year cycle. The energy transition is decades long. The commodity supply deficits that are building in copper and uranium don't resolve themselves overnight. These are slow-moving, powerful forces that will keep pushing capital in the same direction for a long time. And that's what makes this a genuine emergency update in my mind. Not because something terrible is about to happen, but because the window to position yourself in front of these forces rather than behind them is open right now, and it won't be open forever. Opportunities this clear and this large don't come around constantly. And every month that you sit in a buy and hold strategy that has you equally weighted in the winners and the losers, every month you're giving up the compounding that the winners could be doing for you if you held them without the anchor of the losers dragging you back. 45 years of doing this has taught me one thing above everything else. Capital flows toward the best risk-adjusted returns and away from where returns are deteriorating. It doesn't have opinions. It doesn't have feelings. It doesn't care about brand loyalty or which companies we grew up with. It goes where it's treated best. And right now, money is being treated very well in commodities and infrastructure, in the companies building the physical backbone of the next technological era, and it's being treated very poorly in consumer companies squeezed by real wage declines, in legacy media, in traditional professional services being disrupted by AI, in businesses that depend on cheap money that simply isn't cheap anymore. Watch the money, follow it patiently, position yourself ahead of it when you can see where it's going, and never fall in love with anything you own to the point where you stop seeing it clearly. That's the job. It's always been the job. And right now, if you're willing to look honestly at what's in your portfolio and ask yourself whether you'd buy each piece of it today, knowing what you know about where the world is heading, I think you'll find the answer to that question tells you everything you need to do next. The opportunity is here. It won't wait around forever.